Hello, everyone. Today, I'm super excited to welcome Kathleen Waid as a special guest to talk about emerging fraud in the financial industry and the role of fraud consortium products. So, with that, I'd like to introduce first Kathleen. Kathleen is a dynamic leader driving innovation in early stage companies at the forefront of machine learning and AI. She has tackled key industry challenges from transforming fraud preventions to enhancing customer experiences with cutting edge digital identity and compliance solutions. As Chief Revenue Officer at NeuroID and Prove, Catherine masterfully integrates marketing, sales, and customer success to fuel sustainable growth and lasting impact. I'm super excited. Hi, Kathleen. How are you?
I'm great, Gaurav. Thank you. And thank you to Valid for having me today. Looking forward to the discussion.
Absolutely. Glad to have you. So my first question to you is like the banking fraud is evolving rapidly with the digitization. I was reading the other day, like over 57% of financial institutions lost more than $500,000 in direct fraud losses in the past year. Identity theft, account takeover are rising with all this digitization of banks. So I'm curious to understand your thoughts in the current landscape. What are the primary decision points these financial industries need to keep in mind related to fraud consortium?
Yeah, that's a great question. So, we've seen an evolution over the 30 years of fraud prevention using machine learning. Starting in the early 90s, machine learning was used for fraud prevention. And the evolution in the 90s, everybody was focused on coming together as an organization and fighting fraud together. And then we've seen this kind of transition over time from the financial institutions kind of isolating their data and being more isolationist when it comes to what they will share in a network or share in a consortium. So it's gone back and forth from, listen, I'm going to share my data because we're going to link arms and we're going to fight fraud together, to, well, why should I share my data with you? I'm a big bank, you're a small bank, or I have unique data that nobody else has. Why should I share it? Why shouldn't I just use it as a competitive advantage? So I think where we're at today, the industry is facing the question on whether banks will actually band together, just like bad actors do, and share data with the expectation that we're going to fight the bad actors as a unit versus isolationists as one bank versus another bank. Because what the bad actors do is, they run fraud at one bank, they get caught, and all they do is just go to the next bank. So ideally, where I hope what's facing this industry and where I hope that we're headed is we stop looking at fraud data as my personal data and start looking at, if I contribute this data and participate in a consortium, it's better for the entire ecosystem when it comes to fraud prevention.
One of the questions, especially around balancing security and user experience, right? With emerging fraud, the more you put guardrails around fraud prevention solutions, it creates some customer friction as well related to balancing security and user experience. How does financial industries looking to balance adding fraud security or fraud protection measures or technology solutions without impacting the customer experience? And also wondering, do financial institutions are okay to share the data?
So it's the age-old problem, right? I want to produce good customer relationships, generate revenue, onboard new customers, approve transactions, but I also want to prevent fraud. So it is the balance of these two events that the industry has been struggling with for decades. When I think about, the technology that's out there and really digital identities, digital transactions, you're really asking two questions and you're trying to figure that out to balance security and the user experience. The first question you're asking is this party who they say they are? Is it the actual party? Do they have the device in their possession? That's the first question that the technology is helping us tackle. And the second question is, are they acting in good faith? We talk a lot about account takeover, but first-party fraud continues to rise. Just over Labor Day, there was an enormous first-party fraud in New York City where people were going to ATMs. It's really check fraud is what was happening. They were depositing fraudulent checks. They were withdrawing monies. They were attacking Chase Bank, right? So it's one, know who you're dealing with, but sometimes the first party fraud is actually the consumer, but they are acting not in good faith. So when you're balancing fraud prevention versus, convenience, you've got to answer those two questions well. And when I think about answering those two questions well and technology that's available to do that, I would ask, potential providers of service, what's your accuracy and your coverage? How accurate can you predict a fraudulent event, and how much of my current population can you cover? So this can be represented in false positive rates versus detection rates, right? So I want to make sure that I detect the highest amount of fraud with the lowest false positive. And the further separation you can get from those two, you can do it in score bands, you can do it in deciles, you can do it by score number, really get very specific with it. You can do it by product, by transaction type, a lot of variations on how specific you can get there. But the ultimate goal is to have the highest level of detection with the greatest accuracy, with the lowest false positive. So I don't want it to negatively impact my good customers. And then the coverage. Am I covering all my customers? Can I cover my newer customers? Do I have to give more inconvenience to my newer customers because I'm just learning about them? Ideally, no. So if I were to just summarize, when I look at any type of vendor, solution, partner to work with, let's just get down to that balancing act of my detection rate versus my false positive rate. And then I get to make decisions for my business on how I will operationalize the technology at a comfort level based on the fraud impact. I'll give you a more specific example. If the transaction is $100 versus the transaction is $10,000, I'm going to have different ways of looking at false positive detection rate because of the risk to the organization, right? So the continual management of new technologies and layering it in to optimize false positive detection rate by transaction, whether it be an application, an actual transaction, is really key. So, and being able to orchestrate all that in a very fluid way, so the customer impact is only on the fraudsters and not on the mass populations of your good customers.
Well, that's a great point. So on that note, I'm going to check with you, like, any success stories that you think which you can share around the innovation which is happening in the fraud consortium space, which is successfully able to reduce the fraudulent activities. It's hard to do 100%, but at least like they make a remarkable, progress on that side.
Yeah, success stories on consortiums continue to evolve, right? So again, a little history lesson. First fraud consortium was in the early 90s, a product called Falcon, still in production today, currently owned by FICO. And again, that's where organizations came together to share data, to band, just like the bad actors do, band together to ensure when one bank is affected, you can prevent it at the next bank. Because it's like a balloon. You squeeze the balloon in one area, it just kind of pops out in the other area. Fraud continues to evolve. So that success led to additional fraud consortiums that were more specific. That first one was credit card transactions. Then you moved into application frauds and application types. So mortgage applications. There's an auto lending consortium that is out there, right? There should be check lending consortium. So by product, by experience, the consortiums have proven to be valuable to all contributors. The give to get philosophy of consortium is a fair one. If you want to benefit from the consortium information to protect your consumers, to protect your financial institution, you have to contribute to it. So I really like consortiums that stick to that rule. Like, if you're going to benefit, you've got to provide. So nobody feels like they're taking advantage of the consortium contribution. So the evolution of consortiums by product type, I think across the industries, needs to continue to progress. It is this isolationist mentality, I think, overall hurts the ecosystem. It hurts your consumers in the end. And it gives the bad actors a path to wind their way through various organizations from one to the next without a stoppage, without a point to say, hey, we know you did this to bank A, we're not going to let you do it to bank B. And again, it's all a circular situation. So they're not only going to hit bank A, sometimes they're going to start with bank B, and then bank A will benefit because the consortium contribution by product, right, will allow the stoppage at the second place.
Well, that's a great point. Well, on that note, where do you see the future landscape, like how the trends will evolve, or the technologies, will shape the future of fraud prevention? Again, going back to this consortium-based fraud solutions.
Well, so a couple things. I see consortiums. The thing that has not yet been, won in the industry is, digital identity consortiums. There's a lot of concepts about how to make your digital identity portable, how you control it. But if you think about my first comment on, you've got to figure out who you're dealing with. Are you dealing with the person that you believe is your consumer or your customer, or they are who they say they are, right? This digital identity consortium of the future, and again, there's a lot of vendors out there, they do great jobs, but there are still pieces, and you have to get back to accuracy and coverage, how accurate they are at the digital identity, how much can they cover based on the particular transaction type. I really feel like the next win in the space against fighting fraud and balancing that customer experience with fraud prevention is to have unification around a method to deliver digital identities, because those are the keys to the kingdom in today's world. Like if you can have accuracy and coverage on digital identity, think about all the potential to reduce fraud and to make the customer experience so much smoother. But you've got to have the ability and the willingness for people to contribute into that digital identity consortium approach, so all organizations can benefit from it, and we can isolate out the bad guys versus isolating out the financial institutions. So I think that's that's the next opportunity to build a consortium that is valuable ultimately for the consumers. I mean, that's what we're doing, is we're protecting consumers at the end of the game, and we're trying to limit the inconvenience of protecting them. The last thing I'll say is consumers do expect a little bit of friction sometimes. Think about your own personal experiences. When you do, have a transaction that is unique to you and you get a little friction introduced to your experience, it's almost welcome. It's almost like, okay, my bank is looking out for me. That was my thought on the consortiums in the future is we've got to tackle digital identity in a uniform way that becomes portable, that has use cases anywhere from, getting into an Uber. Does the Uber driver feel safe? Are you who you say you are? Does the rider feel safe? To financial transactions, right? So the gamut of consumer interactions will start with digital identity coming together.
Well, that was very insightful. Well, I appreciate taking time and talking with us. It was very enriching experience for me. Well, that's all for now. And thanks everyone for listening in. And thanks, Kathleen.